I had this conversation with a few people, and I mentioned it in my weekly as well. It could be all these other things too, and maybe it is, but they were kind of there before it all happened, and maybe that's just what's left after the tide's gone out. The narrative of the Fed put being in play, the Trump put being in play, but now that there's a deal, and now that the Fed is kind of signaling that they're done with their risk management exercise, what more is there for the markets to look forward to? Not a lot, right? Other than AI, which is a very, very cooked narrative with the, capex concerns coming in. So that's kind of the reason why I think we sold off. Not really because of anything else. I just think it was kind of some profit taking. It's a sell the fact, right? You were bullish because of cuts and the Fed making sure that there's no risk to the labor market, and that's bullish. And then obviously Trump, we kind of seen the worst of it in April, and it was all about paring back, and everyone kind of understood that it was the art of the deal, right? So buy every single dip. Market's going to go higher. There's nothing to really kind of get in the way of it, and if it does, then you're there to buy that dip, right? Because those narratives are so bullish, but those are gone. So I feel that that's the reason why we're selling off. It's just a profit taking of sorts, rather than real legitimate risk off, in my opinion. Oil looking a little bit more constructive. Copper as another cyclical type of commodity. So 200 DMA there, 100 DMA. If we do sell off here, then that's telling you that there is something really wrong, right? But we don't really have that. 10-year. Now, this could be something that could complicate things. Get a good ADP, for example. I think this could actually lead to a little bit more of a sell off, because the only thing that I see right now that could prolong the sell off is some rates volatility, where the narrative about how much the Fed is going to cut next year as data starts to improve, this whole cloud of uncertainty from the trade war has been lifted. I mean, rates will, I think, probably be for good reasons, with yields going up and repricing in the curve. But with a lot of the stocks that have been pushing this market higher are very sensitive to interest rates, right? So they will need some a bit of adjusting, I would imagine, and that's why I see a little bit of a potential for volatility when it comes to yields. So this is something to keep in mind with the data. Definitely, I do think it's going to be a good news is bad news situation. DXY just looks like it's on its way, right? It just wants that 100 handle. It wants to take that out. Oh, sorry, it's already taken it out, and it wants this measured target here around 101.40. Let's look at the euro, since a lot of that's DXY. Yeah, just looks very, very heavy. I've kind of long expected this. I didn't trade this, but the view is that the stimulus news just kind of faded. And so whatever bullish view that was left that people were talking about was actually mostly the dollar side. There was a lot of pessimism in there already at the time, and it just didn't play out. And I think the risks now are shifting towards dollar higher, because I'm expecting, once the shutdown passes, of course, as well, Trump ending the trade war and businesses being able to do what they do. I think this is all going to get reflected in sentiment in the data, particularly in the PMIs and consumer confidence to start with, just because they're a little bit more leading. So yeah, the whole bullish euro case is weak, or I don't know if it's even valid anymore. U.S. growth is still in the high threes, whereas Europe is, probably running at about 1%. RSPT, which is the technology equal weight, over something like defense. In fact, let's do the IWF over IWD. Growth versus value. It's been all growth driving this since July. And will we see a rotation now? If we do get some rates fall, it's for good reasons. It's because the consumer economy will be stronger. And so, tech stocks, I mean, sorry, discretionary stocks. We look at discretionary stocks. Doesn't look too bad, but they haven't performed. RSPD, look at the equal weighted version. You can see that minus Tesla and a few others, it's been looking pretty bad. So those concerns about the consumer, the labor market slowing, if we do get that revival in economic momentum, then we could see that rotation come back as well. In fact, looking at RSPT over RSPD to get that relative performance, yeah, it's been pretty huge. So maybe some reversion in this as the data gets better. But again, yeah, I don't see why we should go into risk off, other than a little bit of volatility to the tech names from rates.